Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, today I'll discuss the U.S. election and how it might matter for credit. It's Friday, October 18th at 4 p.m. in London. Morgan Stanley's positive view on credit this year has been anchored on a simplistic thesis. Credit is an asset class that hates extremes, as it faces losses if a company fails, but doesn't earn extra if that company's profits double or even triple. Credit, to an unusual degree, is an asset class that loves moderation. And here at Morgan Stanley, we've been forecasting a lot of moderation. Moderate growth in the US and Europe, moderating inflation that continues to fall into next year, and a moderation of central bank interest rates, rather than the type of sharp declines that you tend to see around recessions, as we think Fed funds will settle in a little bit below 3.5% by the middle of next year. This moderate economy, coupled with moderate levels of corporate aggressiveness, should be music to a credit investor's ears and support richer than average valuations, in our view. So how does the upcoming U.S. election on November 5th fit into this otherwise benign picture? Who runs a government matters, especially when it's the government of the world's largest and strongest economy. This election is also notable for the differences between the two candidates, who are presenting sharply contrasting visions of economic, domestic, and foreign policy. Against this backdrop, we suggest credit investors try to keep a few things top of mind. First, and most broadly, the idea that credit likes moderation remains our North Star. Outcomes that could drive larger changes of economic policy or larger uncertainty in policy in general are probably going to be larger risks for credit. Second, of all the various policies under discussion, tariffs feel especially important as they can be largely implemented without congressional approval and are thus far easier to see go into effect. Tariff proposals could create significant dispersion at the single name level in credit and pose significant risks for sectors like retail, which import a large share of their ultimate goods. For time-limited investors, tariffs are the policy area where we'd spend the most time and where most of our credit research around the election is being focused. Third, it's notable that as we head into this election, expected volatility in equities or credit is elevated, even as the stock market sits near all-time highs and credit spreads are historically low. So this begs the question, do these options markets know something that the rest of the market does not? We're skeptical. Historically, when you've seen high volatility alongside all-time highs in the market, and it's not all that common, it's tended to be a positive short-term indicator rather than a negative one. And one way we could perhaps explain this is it suggests that investors are still a little bit nervous and not as positive as they otherwise could be. The U.S. election is close in time, uncertain in outcome, and has stakes for future policy. That high implied volatility we see at the moment, in our view, could reflect known unknowns rather than some hidden factor. Tariff policy, being largely independent of Congress and thus easier to implement, is probably the most relevant for single-name credit exposures. And most broadly, credit likes moderation and should do best in outcomes that are more likely to achieve that. Thanks for listening. If you enjoyed the show, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.